For the first time since 2020, the Fed is cutting rates and it's going to change everything. Now, at first glance, this may seem like a positive move. Lower rates generally mean cheaper borrowing, easier access to capital, and a boost for both consumers and businesses. But here's the real question we need to ask. Is this going to signal a market crash or a boom to record highs? The Fed's decision will send shockwaves through the market, and that's exactly what we're going to be talking about today. Whether we see a market surge to new highs or experience a devastating crash, the impact will be massive. Let's start with the year 2000. The Fed began cutting rates after the dot-com bubble started to burst. The tech sector had reached unsustainable highs and the bubble popped. Stocks crashed, pulling the entire market down with it. Rate cuts couldn't stop the downturn, and we ended up in a full-blown bear market. Next, in 2008, we faced the global financial crisis. The Fed slashed rates aggressively, trying to starve off the collapse of the housing market and the broader financial system. While the rate cuts provided temporary relief, they couldn't prevent one of the worst economic downturns since the Great Depression. Then came 2020. During the pandemic, the Fed had to cut rates to near zero to avoid a total economic collapse. While these cuts, paired with massive stimulus, initially propped up the market, we still saw a sharp downturn before the recovery. Now let's talk about 2019, the hidden rate cuts. The Fed quietly cut rates that year even though we weren't in a recession. The economy was slowing, but it hadn't completely stalled. Interestingly, the market didn't crash after those cuts. In fact, stocks rallied to new highs, and that brings us to today. So what's the common theme here? In 2000, 2008, and 2020, rate cuts happened during a major crisis, and each time the markets took a hit. But in 2019, the economy was slowing, not crashing, and the Fed cut rates preemptively. The market responded positively, and we avoided a full-blown recession. But there's another twist in this story. That would be the size of the rate cut. Initially, most analysts expected a modest 25 basis point cut, which would be a typical measured move by the Fed. But over the last 24 hours, something incredible has happened. Wall Street is now shifting its bets towards a 50 basis point cut. Why is this such a huge deal? A 25 basis point cut is seen as a more cautious approach, a signal that the Fed is trying to stimulate the economy without panicking the markets. But a 50 basis point cut, that would send a much stronger message. It's the Fed essentially waving a red flag, signaling that they're more worried about the economy than they've let on. So what does this all mean? If we follow history, this means the market should rally. Once Jerome Powell announces the size of the cut, it's going to be crucial that he has a good press conference where he can calm the market regardless if he chooses 25 basis points or 50 basis points. The next few weeks are going to be critical. Will we see a repeat of 2019 with stocks surging to new heights, or will this rate cut spark a new wave of fear leading to a downturn? Only time will tell, but one thing is certain. This is a moment you do not want to miss. If you want to see more content like this, please make sure to hit the subscribe button so YouTube knows I'm here. Thank you.